Well, we could be seeing signs that the rate of inflation is slowing, but where can investors expect the Fed to go from here? Here's what New York Fed President John Williams had to say about rates and policy in a Yahoo Finance exclusive with our Jen Schomburger earlier today.
We need to do what we need to do in order to make sure we bring the inflation down to 2% over the next few years. So if inflation ends up being higher than I expect, or stickier, as you said, then we'll have to adjust policy appropriately. I think we can adjust as needed, and obviously, and continue to watch the data and continue to be data dependent.
Data dependent, we know what that is. Joining us now, Tom Essaye, Sevens Report Research founder. So, Tom, expressing maybe some optimism there that inflation is going to come down, but at the same time acknowledging it hasn't as much as we would like. What does all of this mean for the Federal Reserve? What's your takeaway?
Good morning, guys. Thank you very much for having me on. Listen, inflation is just still way too high, right? I mean, we're all fixated on the rate of change, and that does matter. But tomorrow we're going to see both headline and core inflation print with a 5% handle on it. Right. I mean, 2-3 years ago, that would be laughable to us to see something that high. Yet we may be excited. Going forward, though, the inflation conversation is going to switch a bit. Before, it's been all about headline inflation, right, which is like 6, 7, 8, 9%. Now it's going to be about core inflation. So that's what I want everybody to watch tomorrow. If it comes in under 5.5%, that's a positive. If it comes in over, well, the Fed still has more work to do.
I mean, it seems like they know that they still have more work to do if they're using their benchmark interest rate as the kind of precursor for what their decision could be and what the discussion will entail. But it could come down to, exactly what the tenor in that discussion is among the voting members of the FOMC. Do you believe that there will be more who look at the data that's come out, whether that be on the employment front, and say, we've got our backstop that's already in place. We can continue moving forward right now?
I think the Fed will be more hawkish than the market is currently expecting. We have to remember something, right? If we look at year-end Fed funds estimates, it's like 4 to 4.25%. So the market is pricing in numerous rate cuts, not hikes, rate cuts before year-end. So I think that the people on the Fed are very aware of what happened in the 1970s, and I think they're very afraid of it, and they should be, because back then the Fed did this sort of schizophrenic jump all over the place, cut, hike, cut, hike, cut, hike, and it really crippled the economy for years and years. I think they're afraid of that. I think the Fed is more hawkish than the market currently expects.
And so let's bring it all back to the market, right, and to what people should be doing in this environment. It seems like today people aren't doing much of anything because they're waiting for more information. We're going to get a lot more information this week. We're going to get CPI tomorrow. We're going to get bank earnings later in the week. How should people be positioning themselves?
We think probably the most clear trend in the markets right now is slowing growth, right? And it's a question of, hey, do we get a recession or do we not? But what we're not seeing a lot of argument is, will the economy slow or not? So I think that's what people should really be prepared for. Inflation will decline over time. We know that. It's just a question of how fast. But we do know that growth is slowing already, and that is going to continue. So we think stay defensive in your tactical allocations, utilities, consumer staples, healthcare, even the super cap tech names that did well over the past 2 weeks. We think that's a good place to hide for the next couple months.
For investors that are looking to trade off of any type of commentary that they see show up within the bank earnings this week, what should they be listening most closely for to best position themselves, even around the anticipation of what a Fed decision may look like? What are some of the key areas that they can keep an eye on within bank earnings in order to position their portfolio?
So I think loan demand is the key, right? So very quietly, the last 2 weeks of March saw the biggest decline in commercial loan demand on record, right? Of course, that relates back to what happened with SVB and SBNY and other regional banks. If loan demand falls through the floor, that's not just bad for bank earnings, which obviously is very bad for bank earnings. It's also bad for the economy, right? We still live on a leveraged and debt financed economy. If all of a sudden the banks are closing the doors to lending like we saw coming out of the financial crisis, that's a new economic headwind. It only strengthens the case that the economy is going to slow.
So, looking then sort of beyond this near-term data and looking into later in the year, do you think that there is going to be more of a realization in the markets that things are going to turn for the worse?
I think that the market has a very optimistic view right now, right? And I think that sure, can you get an inside straight in poker? Absolutely. Is that the way you bet? No. So I think that really investors should think about, hey, the outlook may not be as good as 4,100 in the S&P 500 implies, and are we prepared for a bit of temporary disappointment? No, I'm not. Mike Wilson. I don't think that we're about to go down 20 or 30% in the market, but I do think that the outlook may not be as rosy in the next 3 to 6 months as the market may be pricing in right now.
Do you believe that that means that the economy is going to be in more of a mild recession, or something that we haven't discussed yet, or a harder landing than we've anticipated?
I'm colored by my experience. I've been through similar episodes like this in 1999, 2000, and then '07 and '08. And in both cases, at the beginning, people were saying it's not going to be so bad, mild recession, and they were wrong both times. I don't think what we're looking at is an '07 or an '08, but I do think the economy could slow more than people expect, especially if the jobs numbers really start to fall.
Tom, good to see you. Tom Essaye, Sevens Report Research founder. Thank you.